So whole life, one of the basic building blocks of whole life is the guarantees that it offers. First off, it's going to be guaranteed premium. You never have to worry if there's enough premium for the policy to stay in force, meaning that if you sign a client up and it's $1,000 a year premium, it's the same $1,000 a year now, 10 years from now, however long the premium duration is. Unlike some other products where you may have to figure out, due to policy performance, is there enough premium to keep the policy in force? The premium is going to stay the same throughout the entire contract. And with that, also premium duration. So the length set at the start of the contract is the length of the contract. Meaning if you have a 10 pay, if you're paying to age 65, you're paying to 100, that is the premium duration. So you are going to have that same duration for that same set premium, and these are all guaranteed as part of the contract. So once again, if you're set to pay for 15 years, there's no worry about, do I have to make a payment in year 16 or 17 due to product performance? The actual product itself is built around this guarantee. And with that comes a guaranteed death benefit. Now, this death benefit will never go down as a result of policy performance. So what you get locked in at issue is going to be the guaranteed minimum death benefit that you're going to have for that policy. And then something else that's unique about whole life is there's guaranteed cash value increase that is set in the contract, and most contracts are set to endow to age 100. Now, there will be a little difference. Yes.
Sorry to disappoint. The way that you're sharing your screen, I think, is giving people the ability to toggle, but we're not seeing what's actually on your screen. Can you try resharing?
Sure can. Sorry about the minor technical difficulties.
Yeah, all good. It was kind of stuck at that first screen, but I'm able to, I think we're all able to like go forward, but if you try dropping down the share. Okay.
Let's just go back through.
Now
we should be on the guarantee slides. Okay.
Yeah.
Sorry about that. I'm not sure what was going on with that, but basically I was speaking what was on the slide, so you didn't miss much in terms of what was being presented, so I do apologize for that. So we talked about cash value, and like I said, it is set to endow at age 100, which is where the policy death benefit, the cash value will equal that death benefit. And I will make a note that whole life premiums represented 36% of the total life insurance market in 2024, according to LIMRA. So it is the highest selling product by way of premium in the marketplace. So that begs the question, if you're not selling whole life, someone else down the street will be selling it to your clients. It is a product that is being sold, in various ways, and it is something that should be part of your insurance toolbox. Give me 1 second here. Okay. So there's two types of whole life, non-participating, and this basically means you don't own a stake in the company, no bonuses are paid out. It does typically have less expensive premiums than participating or par whole life, but has overall less cash growth. And then you also have participating. So this is ownership in the company. The participating whole life companies are mutual companies. So when you get a whole life policy with them, you become a member of the mutual. And with that, you have the ability to share profits from the company in form of dividends. These are typically a little more expensive than non-participating whole life, but they do have overall greater cash value growth, which is what you're getting for being an owner within that company and sharing with those benefits. So we're going to go through a couple quick examples. Now, don't feel you have to memorize the numbers on the screen. I will recap them in a couple slides. But all these examples are going to be for male, 55, standing on tobacco, 250K of death benefit, and a pay to 100 type product. You notice for this non-participating product, the premium is going to be just shy of $6,000. You're going to get a death benefit of the $25,000. And you're going to have a cash value within the policy of around $74,000 at age 70. And this is a guaranteed cash value. Like I said, this is regardless of markets, of bonuses, or whatever, as part of the contract, this will be the cash value available in that policy at this point. So then, by contrast, for the same client, a participating policy, you're going to look and we're going to have around 8,500 of premium. Still the same guaranteed death benefit. The guaranteed cash value in this one is going to be a little higher at 82,000, but you notice there's now a non-guaranteed values column. This is going to be as a result of dividends going back into the policy and compounding on themselves, thus giving you a higher cash value as well as a higher death benefit. And this other example of another participating policy, once again around that 8,900 mark, you're going to have those same increased values on the non-guaranteed side versus a policy that is non-participating, which just has the guaranteed values. So we'll just go through a quick overview. You'll see that there are differences, and what is best for the client is really going to depend on what their needs are. For most people, that they like the guarantees, that little bit extra premium to provide that additional protection and additional upside is normally a good sale for the client because that death benefit does grow as the dividends are put into the policy as well as the cash value. Now, I will make a note that like any type of performance bonus or anything, dividends are not guaranteed. But for the majority of the companies in the participating space, they've been paying dividends for 50 years, 100 years, the life of their company. So dividends are not guaranteed, but these companies have a good history of giving good dividend performance and paying dividends forward to their customers.